Yeah, so we expect the US, the Fed, that's our assumption, that they will raise interest rates twice, which will be really continuing at this slow adjustment of monetary policy, consistent with GDP growth that is around 2.5%, and inflation that really increases very gradually, in particular as far as wages are concerned, still some kind of weakness on the wage side. For really the global economy, what this means is still some uncertainty about the pace of tightening, but more particularly really uncertainty about the implications that will have for, in particular, for emerging markets. Emerging markets have benefited from very substantial capital inflows when monetary policy in the US was eased. We know that this is reversing at some point. We don't know at which pace, and we don't know really what the implications will be for these economies and financial systems.
Okay, so Marie, if this is the case, then do we need to be concerned about outflows coming up from some of these emerging economies? You know, because like I said, the pricing has changed dramatically just in 24 hours in terms of expectations. Could be as soon as June, could be a little bit later than that. I mean, we don't know obviously exactly when that's going to happen.
I think that's the kind of volatility that we've seen over the last few months, and that we expect to really remain in place for quite some time, as there is uncertainty about the pace of tightening, as investors really respond very quickly to these changes in perceptions. And so for emerging markets, then the more dependent on, the ones that are more dependent on external financing, some of these are commodity producers, then are more vulnerable to that. And there's really a wide range of situations here. Some emerging markets are less vulnerable, have reduced their current account deficit, and do not have really significant external debt. India is an example. Others are much more exposed. Indonesia has, for instance, significant amounts of external debt and will be vulnerable to really a shift in capital flows.
Which we've seen before, haven't we? I mean, just last year.
And so we've seen some volatility before in these conditions in capital flows. And you're right, last year, really capital inflows to emerging markets really tapered very significantly. They stabilized more at the beginning of this year, and there is really uncertainty as to what will happen in next year. So
one of the key parts of this report, and something that you mentioned to me off air a little bit earlier on, was China. I mean, you seem to suggest that there is still, you know, a not insignificant amount of risk coming out of China.
Yeah, so our baseline view, what we think is most likely to happen as far as the Chinese economy is concerned, is still robust growth at around 6.5%, not really in line with the targets, through policy stimulus, fiscal monetary policy stimulus. And we've seen some of that this year, investment by state-owned enterprises rising by more than 20% compared to last year. We're seeing now maybe steel production rising on the back of recent rises in prices. And so the emphasis is very much on the stimulus. Where the risk comes from is if that stimulus were to become less effective. So that stimulus is in part provided to state-owned enterprises that are highly leveraged and maybe can respond less to kind of easier financing conditions to demand than they would otherwise. Implications for the rest of the world will be through commodities, through trade, and also through financial markets. We've seen really the impacts that China can have on financing conditions.